Top of the day, everybody. Happy Friday to you and happy Valentine's Day. I hope you're with the one you love, and if you can't be with the one you love the one you're with. Like I'm going to love my bosom buddy here.
Yeah, bosom.
Special Ed Milewski joins us again for another day on the cannabis stocks.
Here we are on the trail.
Yes.
Hot on the trail.
Hot on the trail, coming in hot. An expression I heard recently.
And coming in heavy.
Coming in hot and heavy. Ooh. That would imply for Valentine's Day especially that very, very apropos.
How about this?
Oh, Rack Phase, yeah.
Okay,
awesome.
so here we are.
Great show.
Here we are once again.
Yeah, what a week, what a week. Terry Booth steps down, retires, whatever.
There's a report out calling Canopy down to a...
Yeah, Canopy at $1. That report was by a city trader. It's easy to call out a company that's in decline.
But don't they have like $3 or $4 in cash a share? It'll never trade. Yeah. It'll never trade before its cash value.
Well, you know, it's such a blatant. Like, you know, one day the laws will change and it will be a criminal act to publish misleading information to achieve a downward direction in the share price, just as it is currently illegal to publish misleading information that creates an upward trajectory.
But if you have a view, it's just a view. It's
your opinion. Everybody's got. It's like
an asshole.
It's everybody. You said it out loud. I thought we were going to sanitize this show, Edward.
Sanitize it
with you. Yeah, you know.
Sanitize your asshole.
Well, it is the Valentine's Day. What the hell? There we go. Anyways, today we've got a really interesting show. Alan Brochstein is here from 420Investor. Lucas Robinson joins us from CannGoods, and that's an interesting story. Roger Scott joins us from Wealth Press. Roger has been turning in 300-400% wins for his subscribers over the last year. This is what this guy does. Bruce Campbell's going to be here from Stonecastle Asset Management for the Stonecastle Investment Management Cannabis Week Update. And then Morgan Paxhia from Poseidon Asset Management. Now, Poseidon Asset Management was one of the first private institutional type-ish high net worth investment funds in the cannabis space. All right, let's talk about the market, Edward. What little gems of intelligence. I mean, it's all about the FANG stocks going up, 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 up. Coronavirus.
I know.
Smashing the crap out of oil, going down, 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 down.
You see where this ship that's floating around trying to port, they won't take, nobody will take it.
The plague ship.
They finally said, well, we're going to dock into Cambodia.
The plague ship.
I know.
And so what is it about Cambodia that they're like, oh yeah, come on, there's not enough coronavirus here.
Not enough influx of immigrants.
So does everybody on the boat have coronavirus?
No.
Does the captain have coronavirus?
No.
So
they only brought on people that had coronavirus in the first place. They were hoping that the thing would sail into the sunset.
Into the sunset and sink? Like, what's the plan here? Like, putting a bunch of people who are sick on a ship and sending them out to sea, that's not really a plan in my book.
I know.
So what? Now I guess everybody on the ship's been exposed because you're stuck on a boat with a bunch of people with coronavirus. How could you not be exposed? Anyways, it's wreaking havoc with China's market, Japan's market, but it's just causing a fire to be lit in the S&P.
My good friend David Townsend from Calgary, Canaccord, he says, America will always be the cleanest dirty shirt.
America will always be the cleanest dirty... I don't know what that means.
What?
The cleanest dirty shirt. The least dirty clean shirt?
They're all dirty.
Oh.
And this is the least dirty. In other words,
I got
in America, you know what? And you know what else? I'm going to make a prediction right now in front of our crowd.
What?
Trump is going to win the election.
Well, obviously, he's going to shoot all the Democrats. No. He's going to imprison anybody who opposes him.
I read something today by a former Democrat that said, you know what? He's the only positive guy. Everybody else is negative.
That's an interesting interpretation of what Donald Trump is. I'll give you that, Edward.
Okay.
And I also share that fascination. I think the Democrats are a bunch of corrupt MFs who don't deserve to govern. I think that Trump is a way beyond corrupt MF and that does not deserve, is unfit to govern. And really, that's the really sad part about America is there is no government, there is no democracy, and in fact, Donald Trump has become a totalitarian, and I think he's just going to start shooting anybody who votes for anybody else.
He doesn't even have a license to own a gun.
Well, he doesn't need to. He's got all these rabid sister shagging hillbillies out there ready to go to war for him.
Okay, well, you know what?
Anyways, enough of that. Let's not be political.
Okay.
Alan Brochstein's here from 420 Investor. Alan Brochstein joins me now from 420 Invest. Alan, welcome back.
Hey, nice to be here, James.
Alan, we've seen some earnings announced this week. We have Canopy Growth announced earnings, Aurora Cannabis announced earnings, Canopy Rivers announced earnings. Let's start with Aurora. What was your take on that, on the financials?
You know, it was, obviously there was such a setup ahead. We all knew it was going to be bad. And so fortunately, unlike a few quarters ago when they pre-announced and missed their pre-announcement, which was embarrassing, they actually came in line with what they talked about last week. And they had that extensive call last week, and they basically covered pretty much everything. So, you know, maybe it's not that surprising that the stock has had a little bit of a relief rally. And, you know, unfortunately, I would say it's just too little too late at Aurora. And, you know, they promised us a year ago that getting EBITDA positive was their priority and that they would get there. And, of course, you know, the market conditions were challenging and they didn't get there. And so now they're in a much rougher place. I think there are a lot of people out there that think that they can't make it through. And it's easy to get caught up in the pessimism and the capital crunch and all that. And, you know, I think a lot of the bears have some good points, but I think a couple of things that could happen. I think they'll probably struggle with liquidity still, absent any sort of strategic investment, which I'll cover in a moment. But, you know, they have the ATM or at the money offering that they have been and will continue to tap. So, you know, we'll see a little bit more dilution there. They have a little bit of bank debt access, but it's small, so things look tight. And so, you know, investors probably shouldn't be surprised if there's additional capital raising. But, you know, and of course they have nothing now or they would have done it and they'd say something, but there's always the chance of strategic investors. And if you just take a step back and look at the valuation of Aurora and kind of where they are in their business, even though there's a lot of inefficiencies like there are in peers as well, the valuation is quite low if they were able to get the right strategic investor. Will it happen? I wish I could say yes. I can't guarantee that at all, James. But
right.
So, you know, there's a two-sided story on Aurora, I would say.
Sure. Now, Canopy, on the other hand, had a decidedly good news quarter in that they've swung to profitability or increased profitability on increased revenue, 128 million, I think, for the quarter. So what's your outlook on the Canopy story?
So I'm going to disagree with you. Increased profitability, you mean reduced losses, but then we can. So
in this business, we'll take it.
Canopy, let's just say one thing. Thank God it wasn't as bad as everybody else. I think everybody can agree on that. I would characterize today as a relief rally. I have read the press release. I've gone over their filings, and I listened to the conference call. And I was a little surprised that we didn't get this quarter what I expect next quarter, which is going to be some write-downs. And I don't think that's a bad thing necessarily, but they were criticized last quarter. Maybe it's because they have that big cash balance and they don't feel the urgency that some of their peers are, but they were criticized last quarter for not right-sizing their business, and they didn't really do it this quarter either. Although, to their credit, they reduced their operating expenses somewhat. They're still very high. And their inventory actually increased again, and on the call they said it's going to go up this quarter as well. Many of your listeners may not have listened to the call, but I'd say one of the big takeaways that I had was that they're only expecting modest growth in their fourth quarter, which we're obviously halfway through as of this day. Right. And so, you know, the near-term outlook isn't great there. Again, I don't think the near-term outlook is what's going to drive these stocks in the long run. So it's good that the market knows that. But I think when they report it, I believe at the end of May is when they're planning. It's not due till the end of June, that we'll see inventory write-downs and asset write-downs there as well. So, you know, they did use about $400 million of cash between operations. I think that's right, between operations and in capital expenditures. So, I mean, it is a huge fire that gasoline is being poured on it. It's just a little bit less gasoline. And so their cash balance is still big, and you have to look at their cash and their marketable securities, but it's shrinking very quickly. Part of that shrink was due to things like the acreage tie-up and some acquisitions that they did. And then just one final interesting observation. If you look at what Canopy Growth's revenue was, which I think was about $124 million, about 35% of it was ancillary, not from cannabis. And I'm not saying this is good or bad, but it's very different. Like if you look at Aurora as a peer, it's only a handful of $1 million. So, Aurora did some acquisitions that I think were very questionable. And a lot of what Canopy Growth did, and the three big ones were a European pharmaceutical distribution called C3, which it's like synthetic cannabinoids for the most part. That was one. They did something, a cosmetics company, and I'm blanking out on the name on that one. And then they also did Storz & Bickel, which is obviously cannabis related. This other cosmetics company, I know where they're headed with it, which is to have some cosmetics with CBD or something like that. But
interestingly, that company is started by my neighbor's daughter. So,
oh yeah, what's it called again?
I actually hadn't had a chance to look into it. I just heard that the other day. I have it written
down. I just typed the name. It's eluding me. It's not a company I've ever heard of. But those three companies, which I would argue, so Storz & Bickel, that's vaporizers and stuff like that. That's in the same ballpark. But these other two, a little bit questionable. So the actual cannabis revenue for Canopy Growth was up only, when you strip out returns and all that over the last couple of quarters, was up really only modestly quarter to quarter compared to the September quarter in December. But it was much better than peers, which, we saw some of them shrink.
Mm-hmm. Right. Okay, well, and then finally, let's talk a bit about the problems of suppliers of cannabis, cultivators getting paid by retailers. I mean, MedMen sort of brought the world's attention to the fact that, hey, right, one of the strategies to stay alive is to delay paying your suppliers, but the suppliers are not exactly flush with cash. So how is that playing out down in California?
So I'm not able to really name names, but I've done a lot of diligence after that came up in terms of, is this a MedMen only problem or is it an industry-wide problem? And unfortunately, it's an industry-wide problem. And I'm hearing it in California and Nevada. Like I said, it's all off the record, so I'm not able to name names. But we're talking about some serious cash problems. And, as I try to dig into what's really going on, why aren't the dispensaries paying the suppliers? And the number one answer I hear is that cash it's such a premium right now that they want to conserve it as long as they can. And, the brands aren't in a great position to demand it. So it's really impacting a lot of companies, and we're going to see this show up in the financials, unfortunately. It's not the end of the world, and I do expect the capital situation to get a little bit better for many companies, but unfortunately, we're going to see, especially in California, we're going to see a lot of that market just die. And so anybody out there in California saying that they have a great brand and it's going to be profitable, you have to realize that there are some severe challenges in California. I was just in San Francisco for a conference last week, and I actually did some dispensary tours. Prices have come down a lot in Northern California. I don't, that's just based on my own experience. In some ways, that's good. The market's starting to compete with the larger illicit market. We're starting to see some things like consolidation among the three regulators in California that could help. They're putting these QR codes on the windows. I don't think that's going to help. But the reality is, it is not possible for a normal person to know if their dispensary is legal or illegal. And I would question whether or not they're going to scan a QR code which says so on the outside of the store. What I hope to see happen is MJ Freeway, which is Akerna, has a product that goes, they did an acquisition, and they have a product that actually goes on to cannabis products, so that I think this is a more viable solution, theirs or other people's, where you can actually scan your product and make sure that your product is legitimate. And these are the kinds of things that I think, along with better enforcement and more stores being open that are legal, will help California.
Interesting as ever. Thank you very much for joining us again, Alan. We'll have you back next week. Have a great Valentine's Day.
Sounds good, James. Take it easy.
You bet. Thank you, Alan. That was awesome. Anyways,
that was a great interview.
so what do you think about Aurora? Do you think she's going to survive?
You know what? I think the chickens are coming home to roost.
Really? Here's my prediction. Never mind the election. I predict that Aurora is going to go through some painful restructuring, painful for shareholders, painful for its bankers. But at the end of the day, I do believe the company has enough infrastructure to produce enough product to skate past any debacle. It's kind of adopted a too big to fail sort of footprint.
Really?
Yes, for a lot of people, they would rather take the haircut than see the thing fail. And since, let's see, they got $460 million in debt still, in the near term, no, in longer term debt.
And they're writing out, did they write off the billion yet? Have they written off the billion?
Yeah.
Jesus.
Yeah. Well, so anyways, so they've got a lot of stuff out there that maybe isn't up to full speed, and I'll bet you that they start pulling rabbits out of hats left, right, and center by providing, they're in a position to ameliorate a lot of the deficiencies and surpluses in the system. There's a whole lot of imbalance that, because the government's been so slow to set up distribution, retail distribution infrastructure, that can't connect. And I think Aurora is probably one of the best poised companies to make those connections in the background. And through that, as well as their retail business, as well as their medical business, I think they're going to survive. I think
They'll be one of the
that it's soon going to be a buy. But I think it's going to be after the 10-for-1 rollback that I predict is the only way they can survive. I say that out loud. No, that's not. I don't have no intel. I have no intel on that. That's not me saying that. That's just me making shit up.
Richard. You're Richard Nixon.
No, it's not. No. Anyways, yeah, so Lucas Robinson was here. He was speaking at Davos on CBD. He joins us now for a quick conversation about CBD and Davos. Follow us on Twitter, Instagram, LinkedIn, and Facebook. Make sure you never miss a show by subscribing to our YouTube channel and clicking on the little notifications bell. Lucas Robinson, CEO of CannGoods, joins me now. Lucas, welcome.
Glad to be here.
Lucas, let's start with a quick summary of what is the business of CannGoods.
So CannGoods, we are focused on bringing health and well-being, improving that, and bringing that into this market as a personal focus of ours. And we're doing that by bringing certified products into the market.
We're talking CBD?
CBD focused.
Okay. So you are a cultivator, extractor, a formulator?
None of the above. So we come into this market with some outside industry expertise around e-commerce, pharma, med tech. We looked at this market and said, how do we leverage our skills to, again, be part of this health and well-being opportunity? And what we found is that the cannabis supply chain, specifically the CBD supply chain, was a bit of immature, and so we really wanted to focus on getting working with CPG brands. And to do that, we found that we needed to be able to help them bring products to market in a way that was de-risking and also could focus on their ROI. So to answer your question, we are a consulting company that leverages software solutions and focus on bringing products to market.
Okay, so you're essentially a distributor?
No, so it's a bit of again, consulting, leveraging software solutions with also a focus on using that data to find value, and and then there's opportunities to own, make investments into the values.
So who are your channel partners?
Channel partners for us right now, we have supplier channel partners. So we have what we refer to as our CannGoods certified partners, and those are channel partners. So we have a best of class, we like to think of them. That's across extraction, cultivation, co-packing, and packaging. We also have channel partners inside of pharma and med tech that are giving us advising there, looking at, again, as you bring data across your supply chain, that data gives you insights into value creation. And so by having med tech and pharma partners, you can start planning ahead on what it is to leverage that data into pharma filings, for product filings, to accelerate go-to-market. It's one thing to accelerate a go-to-market for a product that's going onto a retailer shelf, which is what we're doing a lot of now. But looking ahead, what is it to accelerate product to market that's going into a medical trial, and by leveraging information that you have on coming through your supply chain. And that is a game that the medtech and pharma folks have been doing for quite a few years. And so we're leveraging those channel partners as well.
You spoke at Davos recently. What was the essence of your presentation there?
So yeah, wonderful group of folks there at Davos, there at the ICANN Cannabis Conference. We spoke about maximizing the ROI of your cannabis supply chain.
Okay. And is that a topic that somehow is of interest to the Davos general theme of global economic sort of, what is it, integration, growth, optimization?
Yeah, well, our company core value is around, focusing on the acceleration of global health and well-being and bringing products to market to do that. And the general theme of Davos this year, at least, was around, it had a number of different focal points, but global health and well-being was one of them. So I feel like it's a theme that not only plays well this year, and certainly there's a decent amount of coverage on it, but certainly something I expect and want to continue to be a part of that Davos theme, because I believe like there's an opportunity for at the World Economic Forum for cannabis to be on the main stage in the context of global health and well-being.
And what is the general sort of attitude towards cannabis at that sort of level, at the Global Economic Forum level? I mean, are they interested just in cannabis as a medicinal thing, or is it viewed in any way, shape, or form as beneficial culturally, or is that outside of the purview of Davos?
Well, it's interesting. I've been a part of a number of conversations there, and you have the executive suite of Fortune 500 companies, and you bring up that you're in cannabis, and all the attention at the table goes to that conversation. And there's serious interest there. There's still a stigma, obviously, in some parts of the world. I think at that level of business, there's of course, they're looking at the business opportunity. But the majority of these conversations do tend to focus around what it is to promote global health and well-being, and using this industry to do that. So I feel like the optics around the industry, as they begin to get centered on that, will have more and more opportunity to bring in Fortune 500 businesses and executives and make it a focal point without the risk to their reputation and their brand.
And so do you have client relationships with any Fortune 500 companies or any LPs that we would recognize right now?
We do have right now a number of conversations with Fortune 500, specifically CPG brands. Not to disclose the clients that we're working with. On the LP front, again, we're friendly with a lot of companies. Right now, our big focus, if you consider what it is to bring a product to market, you can work with there's a number of cannabis companies that are great companies that have made great progress in the last couple of years. But if you really want to bring products to market in an accelerated fashion, you find the CPG suppliers that have been supplying major CPG brands for decades, and sometimes 100 plus years. Bring those companies into the cannabis supply chain, which is where we found our biggest value. Because in partnering with those companies, you can bring their IP in, and their know-how and their expertise and their relationships that they've been developing for decades. And that's probably, if I was to talk about relationships and partners, the most valuable of those are the CPG suppliers that we're continuing to network with.
Okay. Well, it sounds like an interesting time in the cannabis space, Lucas. We're going to leave it there for now and come back to you soon. Thanks for joining me today.
Thanks, James.
If you like the show, you'll love our website. Visit us at www.midasletter.com for interviews with key CEOs, cannabis news, and to subscribe to our newsletter. Roger Scott joins me now. He's the publisher of Roger's Radar with Wealth Press. Roger, welcome.
Thank you for having me. I really appreciate it, James.
Roger, what is the essence of your service at Roger's Radar?
Well, we provide a lot of services that are related to swing trading, day trading, and options trading. They're all for active investors and active traders.
Okay, and what kind of stocks do you focus on?
That's a great question. Several of the services, what I try to do is this. When I used to manage institutional money, what I did was I created several diversified systems. So in other words, I'll have a system that focuses on large cap stocks. I'll have a system that focuses on small cap stocks. I'll have a system that focuses on ETFs and assets that are uncorrelated to the market. So every system, when you add them all together, you get amazing diversification and long-term leveling in terms of volatility, which is really important. So when you ask me that question, we've got a system that literally focuses on every segment of the market.
I see. And the main reason for my interest was the relative deluge of testimonials you've been receiving from your subscribers. Describe what the nature of these testimonials is, and why are all these subscribers writing in?
Well, it's a great question. To be honest with you, and I hate to toot my own horn, but half or more than half, I think 5 out of 8 of our systems are literally making all-time highs right now. The markets have been really good to us. Our trading has been on par. And I've been doing a lot of morning videos, and in these videos, what I do is I ask for, I say, hey, if you like this, if you're getting some value out of this, send me a letter, send me feedback, and people have been just sending us the nicest emails, the nicest letters. You know, I doubled my account, I made a lot of money, I made 400% return, I made 300%. It's been fantastic, really fantastic, especially how we starting 2020 on the right track.
Wow, that's remarkable. Congratulations on that. How did you get into? You said you were an institutional trader before. Is that how you started the whole service?
No, well, it's a long story, but I'll give you the 5-minute puzzle. I originally got into the business by being a broker. I went to law school. I never practiced law. Started out as a broker. Met some amazing people. Richard Dennis's pupil, the current senior financial advisor to the White House. We started some funds together over the last 20 years. The funds made really good money over the years, and we just took it further and further and further. And what I did was I specialized in system development and testing, which are objective algorithms. And in the last several years, the systems, the software to test these systems have gotten better and better. And as a result, we're able to create systems that are just a hair shy of artificial intelligence at this point. They're scary accurate, and the results are amazing, James.
Well, that's fantastic, Roger. So where have most of the gains been coming from in the last quarter?
Large caps, tech and large caps. They've been just going nuts. We've had this thing with China and the tariff war. And as you know, we're now incomplete with the trade one. The first part of the agreement is done. The phase 1 is done. And what that means is stocks are now not too concerned about China anymore. They're making new highs again. So earnings have been better than expected. Volatility has been near all-time lows. Interest rates are really low. And it's been a great time for large caps. NASDAQ stocks, we currently have, get this, this hasn't happened in 5 years, James. We have 85% of all the stocks in the NASDAQ 100, which means 85 stocks out of 100, are trading above the 200-day and the 50-day moving average. That's the first time that's happened in 5 years, and that's telling us the momentum, the bullish sentiment that's driving this market is just off the charts right now.
Yeah, that's incredible. So this money, where is it all coming from?
Well, that's another great question. You see, the Fed right now, I don't know how much of your readers know this, but the Fed has been putting money back into the market. They've been buying bonds. There's a pledge to put $68 billion worth of bonds back into the stock market. The Fed wants to keep interest rates low, and a lot of this is creating liquidity, and it's causing funds, institutional money, to just jump on the market. You may or may not know, but since between 2008 and 2014, when this quantitative easing was in a big effect, the global economy went from the global stock market went from $34 trillion to $68 trillion. And it's been at that level since 2014. Now, for the first time since 2014, the Fed is putting money back into the bonds. They're buying bonds to keep interest rates low because they were very scared that this China trade war was going to go south. They were afraid that interest rates were going to go higher. They were afraid that earnings were not as good as they are right now. So all of these things, all of these factors is creating liquidity in the market. Institutional money is flowing back into the market, and it's causing upside.
Sure. So what is there out there that could put an end to this good time roll?
That's a very good question, James. First of all, every time a percentage of stocks in the S&P 500 or the NASDAQ gets above 86% momentum in terms of momentum levels, we tend to see a cool off. Number two, I'm very concerned about this coronavirus. We really do not know the extent of it. Just the other day, China said it was under control. Today, we're hearing more news that they're using different testing methods and that they found out there's 15,000 additional cases. Car factories in China just recently opened up again, and there's question of whether they'll remain open. So there's a lot of factors involved right now. There's a big wild card with this coronavirus. And also, historically, as we get closer to the elections, stocks have done okay. So I'm not expecting a runaway bull market towards the end of the year, but I still believe first quarter and second quarter will be very bullish if this China virus doesn't eat the rest of the world up, so to speak.
Sure. So I guess it's fair to say then that uncertainty is a characteristic of election years. The closer to election you get.
Yeah, as a matter of fact, statistically speaking, not every election. If you look at election years and if you look at the predominant cycle, there's a positive sentiment every time the same president gets reelected, but there's a big question mark that when it doesn't happen. And again, Trump is facing a lot of issues, to say the least. There's a lot of talk. Democrats are gaining steam. There's a question mark if he will be reelected. Although the polls do say he will, the stock market believes at 100%. He's really good for the stock market. So
Sure.
there's a lot of wrinkles. There's a lot of wrinkles. Will the Fed be able to keep rates this low for the next 4 years? It's a question mark. The impact of coronavirus. Will this China-U.S. trade war amount to something, or is it going to stall and the momentum will dry out? There's a lot of unforeseeability.
Right. Okay, Roger, let me ask you this. Forward-looking statements obviously is part of our safe harbor language here. Had I invested $100,000 or $10,000, let's say, with you in January at the beginning of this year, how much would I be up potentially?
Potentially, you would be up, depending on your risk tolerance. If you traded the underlying asset, you would be up about 12%. If you traded the option, you'd be up about 140%.
Wow. So you leave that optionality available to your subscribers. If they're less risk tolerant, they can just stick to the underlying commodity. If they've got more risk tolerance, they can take out some of the options?
I don't think I'd be able to say it better myself, James. Here's how we do it. Every one of our strategies, every one of our systems will give you the entry, exit, and the stop loss, the risk protection for the underlying asset and for the option itself. So we give you the signal for the stock or the ETF, and we give you one for the options. We do not discriminate. We have some traders who have very large accounts, hundreds of thousands of dollars, $1 million accounts. They don't want the volatility. They're just looking to outperform the market. Look, the stock market has given us 6% over the last 20 years. That's terrible.
Right.
So a lot of investors want to outperform the stock market. 6% a year is, if you can breathe, if you have a heartbeat, you should be able to outperform the 6% a year.
Right.
But all jokes aside, the truth of the matter is, investors have two goals: lessen their volatility, increase diversification, and outperform the market. So we're trying to help them achieve all three goals.
Fantastic. Roger, I've actually subscribed to your free letter at this point. I'm going to subscribe to the paid version. I'm going to throw 10 grand at this and see where it takes me, and we'll have a conversation a month or so later, if not sooner. I really appreciate your input today.
Thank you. It was a pleasure speaking to you. Would love to do this again. Loved your questions.
You bet. Thanks. If you're enjoying the show, subscribe to Midas Letter on YouTube so you stay up to date on everything investment. Bruce Campbell's going to be here from Stonecastle Asset Management for the Stonecastle Investment Management Canvas Week Update.
You're the only person I know that could do that. Like, how do you do that?
I'm pretty sure.
I couldn't say it in the first place.
Auctioneers everywhere could emulate that. If you're enjoying the show, subscribe to Midas Letter on YouTube so you stay up to date on everything investment. Okay, Bruce, so tell us, what did you make of the Aurora financial statement?
Well, I mean, obviously they were messy, right? And I mean, we knew that was going to be the case based on the pre-release. There's a lot in there. I mean, obviously still looking for a CEO. The one thing that I did take out of it, I guess there were a few things I took out of it, but the one thing I took out of it was, their costs are still fairly low, right? They're 88 cents. The cash costs were 88 cents per gram, which was up a little bit from the previous quarter, but that's the range of where they're going to have to be. Obviously, they can drive it lower, and I think they probably still do over time. The balance sheet obviously continues to be a concern, and obviously the sales, we'd like to see more sales. That being said, I have seen lots of sales data from the dispensaries, and it seems like a lot of their 2.0 products are fairly popular. So, and the fact that the stock price, obviously since they pre-released is down, I think close to 20% with the move it has made up. But following their release, the stock price actually jumped up on Thursday.
Yeah, well, that's interesting. I think that we might have seen the worst for Aurora now. I think that the only thing that needs to happen is a 10-for-1 rollback on the stock, and they've got a shot at the big time. Not something that investors are going to want to hear.
Yeah, I mean, you're right. That could be a potential. They also still have to deal with this debt that's coming due, so that's going to be a challenge. And I suspect that you could end up seeing, probably more dilution on that behalf, right, as well.
Sure.
So, but most people are probably pricing that in at this point in time. They're thinking about the worst case scenario, why the stock moves up on a day when the earnings come out and aren't that great.
Yeah, well, I would think they would have to negotiate the covenants with the debt holders to get them to accept the fact that they're going to take a conversion early, post-rollback. And I think then everything would be fine. But anyways, enough about Aurora. What else is really catching your interest this week?
Well, I mean, we saw this release now that Alberta is going to move ahead with vapes. I mean, that's a big category, and it's one that, there was obviously some concern that they weren't going to move ahead with that. But now they've come out and said, yeah, we're going to move ahead with vapes. And I can't remember what the actual selling period, when it will begin, but it's going to roll out in the next several weeks here. And obviously that's a big category, in the US, and we wanted to, I think a lot of those companies are banking on that. So if you sort of extract that out, or, not to use that pun, but like a lot of the companies that will probably benefit here are the companies that do extraction, because, that's where a lot of the product is being used in the 2.0 and specifically in the vapes. So you'll start to see, you could potentially see some ramp up in some of the earnings of those companies. So we were happy to see that, given that that's, kind of one of the bigger markets in the country, at least per capita.
Yeah, you bet. Do you think there's, what do you think the risk level is that vapes as a delivery mechanism for cannabis generally sort of takes on more of a sinister hue in the context of health? They've identified this vitamin E acetate as the principal culprit in the majority of these vapes, but to me it seems that there is not nearly enough research done. There's not nearly enough data around the long-term effects of vaping cannabinoids. And so I wonder to what extent that Alberta is maybe jumping the gun a little bit, as Albertans are potentially sort of want to do just by their sort of national character, as it were. I hope I didn't offend any Albertans out there. I love Albertans.
I mean, if you look at the heat that, say, someone like Juul in the U.S. has been getting, and I mean, that's not cannabis related. That's just vapes, right? They're taking a lot of heat right now, for sure. And I suspect that, this is going to be like anything else that we've seen down the road. There's probably going to be, a bunch of regulations on what you can do and can't do, and how you produce it, and how you, what kind of warnings you have on it. But I think it's probably gonna stick around, but it'll, turn out to be like smoking, right? Where everyone said, oh, this is like the savior to smoking. Well, no, actually it's not. It's just, a different way to do it. And by that point in time, there's going to be a certain amount of people who are addicted, and, they can't quit, just like the cigarette smokers who know it's bad for them, but they still do it, right? So
yeah.
That would be my take on it. That, I mean, that's probably going to come in the years to come, but, it's not right now.
Right. There was an interesting story in the BBC. I don't know if you saw it this week. The title was "Cannabis Oil Products Could Be Off the Shelves in a Year." And the implication was that if the cannabis products that are currently being sold in the UK are not registered with the Food Standards Agency in Britain, that they would be off the shelves, they'd be taken away from sale. And it's not just a matter of registering these products. They haven't really got a framework for approving anything that contains cannabidiol or any of the other CBDs in the UK, despite it being legal for medical purposes in the UK. So do you think that is potentially a threat to the entire CBD industry globally? Is that this paranoia, this lack of policy from the FDA has now sort of contagiously infected the UK, and is that something that could see CBD removed from the entire product mix in the near term while governments try to sort out this lack of policy?
I mean, obviously, it's got to be a risk that you consider. I saw that article, or I saw the headline for that article. I didn't read it. And then I also saw another article talking about how they thought that it could be fully legalized in a year. So, there's so much back and forth that goes around. I mean, obviously, the FDA and, what they're going to, eventually rule on will probably have a pretty heavy hand in what countries around the world do. I mean, obviously, United Nations and World Health Organization also, that's going to probably have an impact on what happens with CBD as well. But certainly there is a potential risk there. That being said, I mean, there's so much anecdotal evidence that's been around on the plant that doesn't seem to show a lot of harm. If it's used as an adult and in moderation, right? It seems to be if it's used before someone's fully mature, their brain's fully mature, and obviously the amount that they're using. But I think probably the delivery method's probably more critical than anything else.
Right. So tell me, Bruce, what do you see as the most critical sort of events or potential catalysts on the near-term horizon going into the end of Q1 here in 2020? And what do you see at this point, now having had the benefit of a month and a half's look back of 2020, what do you see as the big things that have emerged as issues that maybe weren't so much issues last year?
Yeah, so the sales is obviously the biggest thing, right? And I mean, that's going to be the biggest catalyst, and it's going to be also the biggest potential negative. We've heard of Ontario and how they want to come out and roll out all these stores, but it's like everything else. How long before it actually happens? So people are sort of hanging on that thread that, hey, this is actually gonna work, and these companies are gonna have great sales, and we're all gonna be saved in the cannabis industry. But if it takes longer, and maybe they say, well, hey, we're going to delay this, and it's going to be later this year that it starts to roll out, and then we'll see sort of full rollout in 2021. Well, now all of a sudden the brakes go on again, because that's going to be an issue. So that can be a great upside if plans are rolled out according to plan. And then it can be a huge downside if it gets delayed at all. And we know how things go. They tend to get delayed. The other side too that obviously we want to watch is the uptake of these products, these 2.0 products in Canada, because initially there's been a lot that's done, but that's the pent up demand that people were waiting and anticipating. Now we really need to see them start to gain market share from the black market, and I think that probably comes down to pricing. And so the initial impact right away is the people who were sitting waiting for these 2.0 products to show up have now gone out and purchased them. Do they repeat? And you start getting people who do crossover. So those are some of the ones in Canada I look at. In the US, obviously it continues to sort of roll around what's happening with some of these MSOs, what they're going to do, because they still have huge capital needs. Some of them have recently gone to the debt market. Do they do sale and leasebacks? Do they do more equity issues? Can they do equity issues in this environment? And sort of what happens on that front, and that both in Canada and the U.S. will have an impact on who's going to survive. Right? There's going to be companies that just run out of money. Hard to believe that a year ago they could raise as much money as they wanted, and a year later now we're talking about them not having enough money to get their projects completed. So what does that mean from a competitive standpoint, and who disappears and who doesn't? And obviously watching those balance sheets and watching their operations really closely on the downside.
Yeah. Yeah, that's interesting. Now, what do you think when you look at California? I mean, California was supposed to be like the leading market in the world, and we saw the departure of Adam Bierman after MedMen failed to sort of gain critical mass in the market share and is losing money. Caliva out of San Jose laid off 200 people on February 4th. Ease, supposedly the biggest delivery service in Los Angeles, laid off 36 people, and one of the leading vape manufacturers, Canacraft, laid off 40 employees, or about 16% of its workforce. Does that, to you, suggest that California is not going to be the golden land that everybody thinks it is?
Well, it's a little similar to, fairly similar to what's happened in Canada, right? I mean, the market is there. Everyone knows it, but it's still a black market, right? Estimates that I have heard are still, 85 to 90% of the production is black market. So if you're a black market dealer, man, times are still great for you. Yeah. If you're trying to do it in the legal framework, you're having a difficult time, and they got to figure out, how to get the tax issues, the reporting issues, the tracking issues all sorted out so that there's ease of logistics to take that away from the black market. And then obviously they need enforcement to try to obviously the best enforcement would be if you saw lower prices and people just automatically started buying from legal sources versus the black market. We also need the black market to be taken out, from a law enforcement standpoint. And that's not, that doesn't, all of a sudden you just don't get a flood of, guys in windbreakers busting down doors. It's one at a time. And that, that takes a long time to, remove an ingrained culture, much like it will here in BC and in parts of Canada, right? There's people who are set in their ways and they know what they want and they're used to producing a certain way, and it's going to take a while to turn that over. California will inevitably be the biggest market at some point in time, but who's going to be able to survive the weight as it goes from being a black market to a legal market?
Yeah, you bet. So where do you envision deploying capital most judiciously this year?
You're going to have to be really selective. I think that we're probably going to see a rally where you really see the bifurcation now at this point in time, where you're going to see a select group of companies, probably the ones that have been the best stewards of capital to date. And that's a pretty skinny list, right? Like if you take a look and say, well, how much money's been raised and who's done a good job with the money they've raised, that list gets pretty small. So those are the ones I think where the best kind of opportunity going forward is.
You bet. All right, Bruce, that's an awesome update as usual. We'll have you back next week. Thanks for joining us today. Happy Valentine's Day.
Yeah, thank you.
If you like the show, you'll love our website. Visit us at www.midasletter.com for interviews with key CEOs, cannabis news, and to subscribe to our newsletter. I'm joined now by Morgan Paxhia, Managing Partner at Poseidon Asset Management. Morgan, welcome.
Thank you for having me.
You bet. Morgan, in a nutshell, what is the business of Poseidon Asset Management?
Poseidon is an investment firm that's been dedicated to the emerging cannabis and industrial hemp industry, launched back in 2014. And we now have two funds running in the industry, and our first fund being the longest running cannabis fund in the market today.
Wow. So that's pretty much at the beginning of the investability of cannabis. How much assets under management across the two funds?
Sure. Between our two funds and we have some co-invest vehicles, it's about $150 million in assets, and we've already returned a significant amount of capital out of Fund 1. So that's after that. We're still running around $150 million. Okay.
So then tell me, how has the downturn that began in April 2019 treated you?
We've been investing in this space for, going on 7 years, and we are used to these cycles. Obviously, this one was pretty significant. It's just because as the industry is getting bigger, the dollars are bigger. But the cycles have been there. If you remember back to 2014, as you noted, we treat that as the start of the investable industry. There was a massive spike and subsequent burst, far greater than the last cycle that peaked in, January of 2018. So we're used to these ebbs and flows, and how we've managed it is just with the amount of exposure we have to public markets, especially the first fund being a hedge fund vehicle. We can dial up and dial down that exposure. And what we do when the markets get frothy is recycle that capital into private markets where we see better entry points. And today we're still running some of the lowest exposure, really just a few core names in that strategy, just while we're waiting for what we call this phase of the industry is the Darwin Phase, where we're expecting a considerable amount of companies to go away. And it's weird because normally you'd say go bankrupt, but you can't really say that in the United States because of the federal laws. So anyway, we're seeing this recalibration in the industry and just weeding our way through, no pun intended.
Sure. So the consolidation that is essentially the survival tactic in any revaluation to the downside that has gripped the cannabis space, clearly you see an opportunity for the strong to survive, as per your Darwinistic comment there. And the same sort of exists in Canada, where we have a coincident excess of supply of issuers trying to muscle in on a much smaller market, obviously. So can I ask you in which companies does your greatest hope lie in America and in Canada?
Yes, it's interesting. We run diversified investments. Our portfolios are very diversified, but we do have areas that we focus on within that diversification. And when we launched Poseidon, we always had a very bullish view towards ancillary companies, the picks and shovels, compliance solutions, just understanding that this industry would be a highly complex and evolving regulatory landscape, not just in Canada and the US, but around the world. And if you can solve those complex problems vis-a-vis technology, we believe that is a highly scalable business, focusing on a fast-growing industry that is cannabis, longer term having much greater addressable market opportunities in other highly regulated industries. And so that was one of our core thesis, and it was really interesting to us to see the amount of capital that went into plant-touching companies. We were early investors up in Canada with some of the licensed producers. Just given the regulatory environment, we felt that would be a very attractive entry point. But then it did build up a lot of excess, too much capacity build out, and we saw capital do that very similarly in the United States, where we've seen just a tremendous amount of capital flow into the plant touching companies. And we define plant touching companies as those that are in the US that have exposure to 280E, which is that burdensome tax regulation that the industry is still faced with and will be faced with for a period of time. Anyway, so as this industry is maturing, these businesses are very complex. They need technology. And so we're starting to see institutional capital picking up interest on that side, on the ancillary side. And for us, it's very validating, since that was an area that we were very bullish from the beginning on. And so now it's really coming into fruition, which is great. These technologies are able to penetrate many different markets much faster and easier than the CapEx heavy plant touching businesses, and they can scale. And that's what's needed in this rapidly changing environment.
You bet. Can you just give us a quick thumbnail on the 280E burdensome tax regime that you're describing? A lot of people just don't know what that means.
Yes, so this was a tax code that I believe goes back to the early 1980s, where there was a cocaine dealer in Miami that was trying to run a legitimate business with writing off standard business expenses. And the federal government caught on to the fact that he was benefiting from tax write-offs when his business was an illegal business. They created this tax code called 280E, and really it strips away standard business deductions, and so it makes your effective tax rate explode higher. As a cannabis operator, you can't, your COGS are even exposed to it, so you end up with an effective tax rate that can be north of 70%. So it's very hard to be a net income positive business. In our industry right now, we are watching EBITDA margins because we all know that when you add that tax layer in, it's really hard to be net income positive.
Sure. And is that only in effect as long as cannabis is federally prohibited in the United States?
That's a very good question. We are watching. There are a couple policy groups that are trying to resolve that even ahead of a descheduling or a federal legalization. From our standpoint, that's a known aspect of our industry here in the United States. But what we think would be more interesting to resolve sooner would be just banking access, making it federally permissible to bank within the states. We can address the 280E tax code later on. Businesses are still able to build, and investors understand the impacts of 280E. And so we just believe in time that will be resolved and we can manage that. But we do need to reduce the risk with the banking side of things.
Sure. So is that one of the key drivers of your interest in the ancillary businesses that are not subjected to that tax regime?
It certainly has a very different impact on the business, yes. So you have a lot of attributes when you're on the ancillary side. You have much easier access to banking, your insurance coverage, premiums are far lower. You're just treated much more like a traditional business. But these are early stage tech companies. So, these are on the trajectory of 18-month cycles of raising capital. Revenues are still low relative to their counterpart on the plant touching side. So we look for other KPI metrics when we're on that side, because we believe that it will take longer to penetrate deeper into that revenue stack. And a great example of that would be take like a point of sale company in cannabis. One of our Fund 1 companies being FlowHub is doing a fantastic job expanding across the country, but we still don't have payment processing. So, unlike Square that is able, Square, some of these others where you get a percentage take rate on transactions, point of sale in our industry is faced with more of just like a monthly SaaS-based model, which is a very different revenue mix. So when we can add payments in, that will be a big boom for ancillary type businesses.
So then is that sort of the core of the technology aspect of the ancillary focus, is technology platforms related to information technology, or are there other technologies that are more mechanical, shall we say, in nature, physical?
Yeah, great question. Technology is a very broad definition, right? So there's many different ways you can slice technology. We certainly have had a data-forward mindset when it's come to tech. I mentioned FlowHub. Headset is another company of ours that we've been invested in for a long time, and they do data analytics and working with Nielsen with their data sets because they are so deep, and having the ability to be real time is an incredible competitive advantage. But as you're looking further down the tech spectrum, consumer devices is an area of technology. It's the hardware, so Pax being an early leader on that side. But we're seeing a lot of interesting innovation. We do have a company with a new consumer device that has no heating and creating vaporization. So it's really interesting tech. We think it could be transformative for the space in the years to come, not only for cannabis, but you could think of how that could play into the tobacco space as well. But then you also have like ag tech. Ag tech is an early area we invested in. We believe that the plant is ultimately a commodity, and your cost of production needs to be very finely managed, or else you could lose money. And you really haven't seen that too much yet. Oregon, Washington, state went through some pretty excessive price drops due to oversupply. But even states like Colorado, more mature markets, they've seen a stabilization in wholesale prices to the point where you can still run not the most efficient ag-like operation and still be a profitable enterprise.
Sure. Okay, Morgan, how do you onboard investors? How do investors who are interested in investing in your fund find you?
Sure. So we are a private fund. So under our regulatory restrictions that you have to be an accredited investor or higher to be able to invest. But we do have a website, Poseidon.partners, and we're also very active on social media via Twitter, LinkedIn. So our information's out there. I'm happy to speak with folks. We are at the tail end of raising our second fund. Only a couple weeks left. So people that are interested that meet that accredited investor status, please find us on our website.
Great. Well, I'll look forward to speaking to you again soon. Great contribution. Take care. Follow us on Twitter, Instagram, LinkedIn, and Facebook. Make sure you never miss a show by subscribing to our YouTube channel and clicking on the little notifications bell. Anyways, that's our show for this week. Happy Valentine's Day, everybody. How does that go?